we're seeing record volume again this year. It'll be the 6th year in a row with record option volume. We're averaging about 59 million contracts a day. That's up 20% from last year. We had a day over 101 million contracts. What's really pushing this volume continues to be the drivers we've seen over the last couple of years. It's a lot of retail engagement and it's a lot of short-dated option trading. A lot of people call it zero-DTE.
What is the performance of FlexOptions?
FlexOptions are really interesting. They've been around for about 30 years, but we had over 140% growth in Flex last year. And this year we're up another 40%. So we're averaging almost 2 million contracts a day in Flex. FlexOptions are basically customized contracts. They're listed options cleared by OCC, but customers get to determine the exact expiration date, the exact strike, if they want American or European style. There's a few other in the index options. You can actually do delta just on close. And the reason they've become so popular is there's two reasons actually. One is the defined outcome ETF space, where flex options provide the perfect profile that they need. If they need an 8% out of the money put, they actually can buy an exactly 8% out of the money put on SPX or another product and get exactly the contract specs they need. The other reason is a trade called reverse conversions, which is actually a stock loan trade. It's a carry trade. It's not directional, but options and flex options in particular, because you can set them up European style, are the perfect product for these RevCon trades, which basically let prime brokers and stock loan desks lock in a borrow rate for people to short stock.
How are Tuesdays and Thursdays doing?
We're basically right past the third anniversary of when Cboe added Tuesdays and Thursdays, which filled in the entire 5 days of the week for expiration cycles for SPX, also for XSP, which is the mini SPX. So currently, more than half, actually 55 to 60% of the daily volume in SPX is zero-day contracts. So contracts trading on the day that they expire. This has been one of the most interesting trends I've ever seen in the business. It's primarily retail driven. The majority of the activity is capped risk trades, meaning either customers buying options so that the maximum risk is the premium, or selling vertical spreads effectively. So you can't lose more than kind of the distance between the strikes. We see a very persistent type of activity, which is the selling of option condors, which is a vertical call spread and a vertical put spread. The idea being that if the index kind of stays in between, you're going to be able to collect the premium on both. That's kind of the heaviest volume that we see in it. But we also see people using it for tactical trades. Today was, the Fed had comments today. So, you see people basically getting into trades that they only last through the close today, but they kind of get people the exposure that they really want if it's specifically about a catalyst or some sort of event.
What was your reaction to over 100 million contracts traded on April 4th?
I guess it wasn't a huge surprise because we knew the night before that the announcement, had the markets were going to move. I think what surprised me the most was how smooth it was. We did not have any major errors. We didn't have exchanges that were shutting down. I mean, we traded, in terms of the number of executions, over 10.5 million trades took place that day. Okay, just 5 years ago, the average count of trades was about 2 million. When the market gets really active, you're dealing with a lot of quote changes. You're also dealing with a lot of throughput in terms of trades. And everything basically worked fine on that Friday. It was an amazing day. We kind of knew because we'd approached 85 million contracts twice. We knew that it was possible, but really it all happened, and it happened very quickly. And SPX that day traded over 6 million contracts. The prior record was 4.85 million. So it was an amazing day.
Has the shift in the volatility dynamics impacted the way investors are hedging?
One of the interesting things that the market intelligence team, which is led by Mandy Zhu, looked into is that the reactivity of implied volatility has picked up, meaning when the market moves, vols actually really shift, okay? So volatility rises, volatility structure steepens, okay? That's actually kind of a shift. 2022 and even 2023, the market volatility didn't actually move a lot, even when the market would have, a 1 or a 2% sell-off. The fact that this year we've had, 3, 4, 5% sell-offs, more than once, basically has options kind of behaving like they used to, which means that hedgers who, might buy a put or a VIX call to protect their portfolio, they kind of get the extra oomph out of the fact that the option that they own, it may be closer to being in the money, so it goes up in value, but also because implied volatility is spiking, you get a big boost in value out of that. And that that really has brought back kind of more of the traditional hedging, because there was a period where it wasn't really behaving that way. And some of the hedge performance, like 2022 is a good example. Even though the market went down 20% that year, people that owned puts didn't actually do very well because it was such a steady decline. This year, because we've seen realized volatility really, really spike, especially in early April, to see realized vol go up to 40 or even 50, that's what you want, right? The sudden shocks are where a hedge really, an option hedge performs the best, because then you kind of get that instantaneous explosion in value.
How have execution sizes been changing?
For a long time, we've seen a trend where the execution sizes were getting smaller as volume was going up. Okay, so this was kind of coming for two reasons. You have more algorithmic access to the market by the professionals. So you have fewer, we still have kind of a stable number of large block trades, 1,000 lots, 5,000 lots. That's been pretty consistent, even going back 5 or 6 years. But 5 or 6 years, since then the volume has tripled. So that the tripling is coming in smaller trades. So we're seeing more trades, as I said, 10 million trades a day. The average execution size is about 6 contracts now. It has kind of leveled off. So, and the other reason for that is small retail traders are coming in, they're making small trades. Even in the zero-day SPX, the average trade size is only 3.5 contracts. And that's really kind of striking compared to the longer dated SPX, where the average trade size is around 12.
How has increased trading automation via apps and bots impacted markets?
Basically, retail interacting through these automation tools, okay, which are generally third-party products that connect to a brokerage platform through an API. This has been a really interesting trend over the last 4 or 5 years, really kind of since COVID and since the zero-DTE trading wave took off. And there's dozens of these systems out there now. And customers, retail customers are actually using them to basically do systematic strategies that they could have never done before for a couple of reasons. One was the tools didn't exist, the daily expirations didn't exist, and these strategies kind of work best if you can repeat them. And the liquidity in the options market, especially the zero-DTE, front term SPX, is so good that basically these trades, when they're getting in and they're managing their risk by either taking profits or using stops to get out, they're able to do this without a lot of friction. So, it's cracked open this whole, world of creativity, in terms of creating a bot to basically execute the kind of trade that you say, okay, this is what I want to do, and I want to do it every day, and I want to do it, at certain time intervals. And that was actually the last slide that I showed in the State of the Industry deck, showed the zero-DTE activity in SPX and how there are these really interesting spikes in volume at the round minutes, meaning at 10 a.m. and 10:15 and 10:30 and 11 a.m. And it surprised people in the room who have been in the business for a long time. And we look at data all day long. And when I saw it, I was like, wow, this is really kind of amazing. And it shows you how much algorithmic activities going on. It also suggests that people really want to maybe think about the way they're executing, because we've done this for a long time. And when the market starts to anticipate certain types of activity at certain times of the day, then the execution quality can suffer. So people need to be a little bit careful.
What does TradeAlert look like as part of Cboe?
I ran TradeAlert from 2005 to 2019, and then we worked out a deal with Cboe. We came in during COVID, so nobody's coming to the office. TradeAlert is still a standalone platform within the Data Vantage department of Cboe. We're basically supported by the support resources that Cboe has for all of our platforms. We have 4 platforms. We have data feeds. We have Data Shop, which is sells dozens of data sets. It's now all supported by one team. The infrastructure is much more robust. It's really awesome, and the sales team is basically able to kind of go see clients and solve their problems. And TradeAlert is one of those solutions, but it becomes another tool, in this the arsenal of what you need to interact with the market that's trading. The levels of activity that we're seeing today, especially when most of that is trading electronically, and you need tools to make sense of it.